Yes, what's up?
Just a second. Good, thank you. How are you?
I'm good. Anyhow, I see a lot of people starting to join. We're gonna have a lot of participants, I think, today.
Thank you, Toma. Hello and welcome everybody to this Q2 2020 conference call. I'm Jeppe Kirk Bonde. If you want to use this presentation for anything, please go ahead and read the disclaimer below here. The agenda for this conference call is that first I'll talk about my background, then my investment strategy, then my portfolio, and finally there'll be an opportunity to ask questions and get some answers. So the reason many of you are probably copying me is that since 2013, I've had an average annual return of 28% per year. That's better than most good investors you could fairly compare with, and also with a relatively lower volatility. Kathy Wood, she used to be up there with me, but in this year she's taken quite a beating. I've lost money this year as well, so has most of the major indices. So the 28% you have to think of as that's the average of all of the years averaged out. It's not the, that every year it's 28%. There are good years and there are bad years. A year as we're experiencing now, you could effectively, not as a year, but individual months experience every 4 years. So it's just something that happens often. And I always say in any given month, you can potentially win or lose 20%. In a year, you could potentially lose half or double. That's just the nature of stock markets. My background is that I used to work as a management consultant, advising very large companies, including some of the largest banks in the world and tech companies and others. And I focused on strategy, operations, and valuation. And valuation means calculating how much a company is really worth. And that's very important for big business to know for many different reasons. Then as I was doing this work, I started to also invest my own money on eToro. And then as that started to go very well, people started copying me. And then eventually I was number one on eToro with more than 20,000 people copying my investments for more than 60 million. I don't do everything on my own. I have some good assistants that help me with financial analysis as well as grunt work. I have a good network of experts that I can trust on complex issues in particular. So that's sort of the way that I can learn about new things faster. You can always get the knowledge somehow, but you need to do so at a very high pace. And one thing that has been added to that in I guess a year ago or something is eToro's offered this network service. So if there's anybody anywhere that I want to talk to, eToro can help schedule, or the network service helps schedule the meeting. So this, for instance, helped me when the Chinese government was cracking down on some of their gaming companies. I was able to get a meeting with one of the executives from one of the big Chinese tech companies to talk to him about that. And similarly, when Russia was invading Ukraine, I was able to get a meeting scheduled with an analyst from the CIA, so I could very quickly sort of get all of my stupid questions answered. And in general, I get good support from eToro. Whenever I have any questions or concerns, they are usually dealt with pretty quickly. Then I subscribe to all the best data providers, so I can get the best data in the best way, and to be able to automatically look at as many things as possible. And then my three favorite experts are my three brothers. One of them, he's worked for several years for a large tech company with AI, and now works more with regulation of AI. One is an economist in the Ministry of Finance, and one is the CEO of a marketing company. So if I have any questions or concerns in these areas, then these will be my go-to guys. Then my investment strategy has all along been based on some principles. These principles are still here right now, and I expect they'll continue to be there going forward as well. Firstly, I look at macroeconomics. So that means looking at all the different granular pockets of the global capital markets and seeing what kind of growth rates I really think that they can have. Then I look at mega trends. So these are trends where they can grow for potentially more than 10 years with potentially more than 10% per year. I look at fundamentals. Many of you have probably heard of fundamental analysis, the correct way to invest. That's what I do. That means conducting due diligence, which means really getting a deep knowledge of the companies. So understanding what's the management like, what are the products and services like, what's the competition like, what are their strategic opportunities, how could they be impacted by different scenarios, what are their financial statements like, how much cash could they generate in different years in the future. And all of that is, of course, with an eye on creating a valuation of the company, an assessment of how much is this company really worth. If I'm a part owner of this company, how valuable is this thing that I own? Not necessarily with the idea if I'm going to be selling it or buying it, but I want to know what it's worth. Then based on that, I can decide, where am I getting the best deal overall? Is it this company or that company? And of course, want to invest in companies that I think are worth a lot more than they cost. Then I focus a lot on the long term, and that's the one that's potentially the most difficult for people to understand, the most counterintuitive, because obviously if you do well in every short term, you'll also do well in the long term. So why not just only focus on the next second. And the reality, past history shows us that if you're running an investment portfolio or a business or even just your life, you overall do better by focusing on the long term. That's why I do it. There's a good quote from Benjamin Graham, the author of The Intelligent Investor, sort of Warren Buffett's mentor. And he said that in the short term, the market is a voting machine, in the long term, a weighing machine. And that effectively means that in the short term, it can be very important to guess, what someone else's opinion might be, or, oh, is this insider trading because he knows something? Is this all of that? But in the long term, if a company grows to become very big and profitable, it'll probably be very nice to own a large part of that company. And I'm very happy to wait around for that to happen and then sort of slightly ignore the noise along the way. I focus a lot on risk management. That includes diversifying across different geographies, industries, and business models. That last one is, I would say, the most important, I think, and also very often overlooked. There are many large funds that are well diversified across geographies and industries, but because of whatever strategy they have, they end up finding a lot of companies that actually have one weakness that goes across them. And if that materializes, they can get very, very poor returns. And I saw, for instance, one that had lots of different companies in lots of different countries, but all of them were basically on the hit list from Amazon. So if Amazon does really well, they will all lose out. So that's not actually a very well diversified portfolio. I currently have 60 different investments, and none of them make up more than 5%. In general, I prefer if the biggest investment is no more than 5%, but it can happen if either something's good enough to warrant it, or especially if it has a specific risk profile where it might go up when other things would go down, so that it sort of reduces my overall risk a bit. And then finally, I hedge against tail risks. So these are risks that are quite unlikely to happen, but if they do happen, they could have a very big impact. And so for each of these, I like to have at least one asset that I think this could sort of protect me in that scenario. And recently, because I had some defense stocks, for instance, there I was a bit less hurt by Russia's invasion of Ukraine than I potentially could have been. Then finally, I like to focus on keeping fees low. That means that I don't use shorting or leverage. I don't use the highest fee instruments, and I try to keep a low trade frequency. That's just one more way you can sort of squeeze some extra profitability out of one's portfolio by keeping the fees low. Then there are some areas based on these principles where I find great opportunities. I very much like organic growth. That means companies that are selling more products or increasing the prices. Increasing the prices is currently very important because of inflation. If you are a loser in the game of price increases, then this can very, set you up poorly for the long term, and of course cause your profits right in the short term. But growing organically does not mean growing by buying other companies. Quite often you see in the start of an annual report, a company will say that we grew the business by 4% this year. But then, if I've analyzed them, I might say, actually, the core business shrunk by 2%. You only grew because you acquired someone. So it's not that impressive, actually. There are some companies that buy a company for a low price, and a few years later, they've turned this acquisition into an amazing part of their business. An example was, for instance, Meta, when they bought Instagram for only $1 billion, and then after that grew it massively. All of that growth after the acquisition, that's organic growth. But if you're just growing by buying something, that's not very impressive. And it's especially not impressive if you are destroying what you're buying, which has been the case for especially, many companies are very guilty of doing that because they just want to achieve that growth, and they'll do that even if it's damaging to shareholders, because shareholders don't always understand this. I very much like high growth if it's paired with a high proportion of the cost base being fixed or relatively fixed, because then it makes a company very scalable. It effectively means that as the company becomes much bigger, it also becomes much better. So you get a bigger company that's also more profitable, and that can of course completely change how people view this company in the long term. That's why it's so nice. And that profitability that you can get is very important to me. I do prefer companies that are profitable or have a quite clear path to solid profitability, measured in real terms, because profit means many things, and when you read a financial statement, it's not even a real term anymore. So you have you effectively have to get to free cash flows, and otherwise there's it's sort of a proxy for free cash flows. I especially like companies that are also able to reinvest that profit into their own business, so that they can basically help me compound my returns, rather than just giving me back the money for me to have to find something else to invest in, but that they can actually themselves find great opportunities to help me. Then I like companies that have a new business strategy, provided it's a good strategy and I believe they're actually going to do it. So sometimes you have a company that announced a new strategy, but then when I sort of dig into the details, I see actually, this is not really a new strategy. They're going to continue doing exactly what they were doing. Other times you have a company that does genuinely change their strategy, and I can see they're not just saying it. Maybe they make some actual changes that prove to me they're serious about this. An example of that was Orsted. When they changed their strategy, they also changed their name, sold off part of their business, and really focused only on one thing. And that proved to me that, okay, they're really serious about this. And then that became a fine time for investment. There's also the other side. Sometimes I've seen a company change the strategy where I did not like the new strategy, and this has then been a point of exit for me. Then, of course, it's very important for investments to predict the future and the near future. And a big part of that is just understanding the present. So when Steve Ballmer, the former CEO of Microsoft, he held the first iPhone in his hand, he said, doesn't have a keyboard. Business users won't like it. It's way too expensive. I feel very good about our position. And he was, of course, proven wrong by the success of the iPhone. And that was an example of holding the blockbuster product in your hand and not being able to see that it was the blockbuster product. And many people in recent years made the exact same mistake with Tesla. If you're a smart shopper, if you're good at making purchasing decisions, you're not always coming back a year later regretting the purchase you made, but this feature is important, this one isn't. Here I should pay an extra price, here I shouldn't. These are the important specs that I need to be aiming for. If you have that sort of product knowledge, then that is key to understanding businesses, which is key to understanding investments. But if you don't understand the products or the services, then that's a big part of the puzzle that's missing and makes the whole enterprise quite difficult. I like companies that are mission driven, not just because I sometimes believe in the mission, but also because it can be a way to attract great people and keep those people there, keep them motivated without necessarily overpaying them. You have some companies that are magnets for talent, where people are willing to almost take a salary cut just to go there to work with them. And you have others that are bleeding talent. Good people will not stay there. And whether you're in one camp or the other might not show up in next quarter's results, but it potentially might 1 year down the line. Then if we look at what have been good investments historically, the two big categories are stocks and property. Very rich people own many different things, but these have historically been the two big winners. You want to own a lot of businesses and you want to own a lot of property. And I think that is also the case for the future. Bonds were historically quite good too, but with the current very low yields mixed with high inflation, they are, I think, not a very attractive asset. And I think that's commonly accepted. If interest rates come up, if inflation comes down, and other factors happen, it could change. In that case, maybe I'll add bonds back into the mix, but currently I don't have any. Commodities have historically not been that great. If you lived during the Roman Empire and you had one gold bar, and then you gave that gold bar to your child and he gave it and so on, then today you still have one gold bar. The gold bar didn't give birth to any baby gold bars. The gold bar didn't charge rent. The gold bar didn't do much. If you instead own property, that property might have turned into a village, might have turned into a town. If you owned businesses, that business might have turned into a bigger business, which might have turned into other business and so forth. So you have these assets generally grow, whereas a commodity of its own doesn't. However, it can potentially hold its value against many different things. And in more recent times, they have gone up more, and potentially in the future they will go up more. Currencies have historically not been great. Of course, the worst cases have been where you've had a major currency like the German currency after the First World War going down to basically zero. And nowadays, some of the biggest, most trusted, most well-managed currencies are suddenly finding themselves with inflation much above target. So that's of course not very nice. And so many people that do have a lot of their money parked in cash, maybe they'll get lucky in the short term that, if you a few weeks ago had everything in cash, you might just have dodged, that decline. And then, but the people that are very often taking everything into cash and are very often having a large part of the assets parked in cash, there are none of those people that have made a lot of money in the long term. It's too difficult to do, and on average you lose out by too big amount every year. So even if it works out in an individual period of times, it's sort of a recipe for losing in the long term. Then if we look at the big factors that can really drive the global economy, I like to firstly review what we have out in nature. So how many trees are there, how much agricultural land, how much oil and gas and metals in the ground and all of that, because that's the landscape in which we invest. Then I like to look at life, animals, but more particularly humans. How many humans are there, where are they, how old are they, and down the line, what's the demographic profile going to look like instead. Then some of the things that can cause the biggest changes in markets the quickest are the social ideas. And of them, the most important is just trust. Stocks, bonds, a piece of paper that says that you own your house, or some digits on the screen that says that, are all just documents and digits on a screen. If they are enforced and we believe them, then they have value. But if we stop believing them or they're not enforced, then they fade to nothing. And trust in these social contracts can help us cooperate. It can help us create a lot of value. But if we stop believing in these, then that value can disappear very quickly. Then there are some movements that can cause big changes, often over longer periods of time. If we think that a house has value, that's because we like to live in the house for various reasons. But if we all of a sudden just wanted to live in tents or be nomads or sleep outside for whatever reason, then houses wouldn't have any value. So as our values change as humans and societies, then what we value collectively changes, and then what is a good investment changes. And sometimes if you have some movements where things are changing at a fast pace, even if it's coming from a small margin of society, it can suddenly be everywhere, and that can be very important to look out for. Then investors, politicians, and many others are, over the very long span of history, a little bit just following in the wake of science. The biggest returns on investments over history have been delivered by the greatest breakthroughs in science, and especially where we've had new foundational technology, going from hunter-gathering to agriculture, and through industrial revolution and computers, and now to the internet, and finally to deep learning. Then there have been a lot of great scientists who didn't manage to create a lot of value from their breakthroughs. You need innovation, both in terms of creating the businesses, also the new regulations and so forth. And when we then take all of these grand macroeconomic themes, then that brings us to where the world economy is today. So if we look at the GDP growth across the world, it's not as good as it used to be. Inflation is a lot higher. It may potentially come down a bit, but it's certainly not come down as quickly as many thought it would. And that, of course, means that we cannot keep expanding liquidity at the rate we have been doing. It has to come down, otherwise we lose one of those things we trust that we can use and that create so much value over time, and that would be too devastating. Unemployment has come down a lot in America, where you're facing in many places more of a worker shortage, but in the EU and Brazil and in other areas, it was bad before COVID, during COVID, and still quite bad. And there's of course some regional differences there. Interest rates are still low, coming up, and there are different debates on where they might end up long term. Could potentially be 3%, but that's certainly something that's gonna, it's quite likely that that's going to take the world into a recession. And of course, with a recession, you are getting less profits from your company. Maybe you won't get that salary increase you were hoping for. And when you have a world that's just not looking as good as it could, if you have a world that's maybe not even looking as nice as it did in 2018, then that sort of leaves you thinking, you still have to deploy your capital. Where is the most interesting what are the most interesting things to be invested in? That's always the question. It doesn't matter whether you are in a great time or a bad time. You're still faced with the same question. I have this money. I need to place in the best way I can. And that's also the case here. Just because companies don't look that great with high inflation, money doesn't look that great either. So there's sort of still a need to be diversified and a need to hold assets that can weather the inflation storm, assets that are more getting a share of the nominal growth than the real growth. Companies that if inflation goes completely wacko can just increase their prices. And yeah, then if we look at there are some mega trends that I think are extra interesting. So if a company is following or driving or riding one or more of these mega trends, then it's more likely to be found in my portfolio. So firstly, there are the need to haves. Chief of all, security. If we destroy our environment, if we get invaded by neighbor countries or other travesties occur, then everything else falls away. We can't have the nice to haves without the need to haves. And that includes not just the companies that are helping us save the environment, defending us. It also, for instance, something like the metals that are needed to make the green transition. If you're dead, you can't do much. So you need to protect your health. And there are companies that are helping to protect your health, and those are to be found in the portfolio. Then, if that's all taken care of, we can have the nice to haves. There are lots of great gaming companies that have quite high profit margins that are growing a lot and don't cost much compared to it. And that's something that we can hopefully see a lot more of in the distant future. Then when humans are not spending all of their resources competing with each other on the battlefield over who can have the better weapons, then we tend to compete on fashion. And there are a lot of great fashion companies that are having extremely good profit margins, high growth rates, and don't cost that much either. Then the technologies that are enabling and accelerating all of these things, chief of which are deep learning. So I think that's the sort of the biggest technology in our age, and the companies that are delivering the big breakthroughs in this one, they are to be found in the portfolio. And that of course helps us to get to the ultimate devices one day. Then when you've identified a industry or group of companies and you want to compare them quickly, then a great way to get an overview is to look at the multiples. So this is an example from FANG, so Meta, Apple, Amazon, Netflix, and Alphabet. And if we look at the top left corner, this is their consensus estimated profit margin for the next 12 months. So we can see that they're all looking very fine, but Amazon's lagging a bit behind. If we look at their anticipated growth rate, then again, they're all growing, which is nice. Some, but not, by the same amounts that they used to. Maybe you would say that they were once more startup-like with the amazing growth rates, and now sort of the expectations have come more down to a teenage company growth rates. And Apple certainly lagging a bit behind on that one. The two top charts, the higher the better, because they're about profitability and growth. But the two bottom charts, the lower the better, because they're effectively about price. So at the bottom left corner, we can see that for every dollar of profit Facebook has, we have to pay $14 when we are investing in the company. And that's actually lower than historical averages across all companies. So if we believe that Facebook can have this profit margin and even any growth rate in the far future, then this seems very, very attractive. For Amazon, on the other hand, we are paying $59 for every dollar of profit. So we only want to pay that much more if we believe that they can increase their profit margin in the future, or maybe sustain this higher growth rate for longer or something like that. Otherwise, we wouldn't want to pay more. When we then look at the bottom right corner, we can see we are paying $4 for every dollar of revenue we're getting with Facebook. That seems very fine. For Apple, we are paying a bit more, and they don't have as high anticipated growth rate, but potentially they're a safer company overall. For Amazon, we're only paying $2 for every dollar of revenue, but Amazon's also getting a lot less profit out of every dollar of revenue. So that sort of makes sense. So with the multiples, you can sort of get a quick overview and quickly compare companies and some different factors. I usually don't look so much at charts. I tend to look more at just big data tables. It's not as nice, but I would say it's more flexible, and it can to some extent be faster. all those data tables generally come in automatically into my financial models. I also complement them with my own subjective data sets. So this could be something like, how much do I like the CEO on a scale from 1 to 10? So it's subjective, but it's also numerical. So I can use it in my financial models. All of that input then goes into my analysis, valuing the companies, considering how they would be impacted by in different scenarios in the future. And those analyses then help me make decisions. These can be research decisions. So a company looks attractive. I have to research it more. In researching them, maybe I find out about a new risk. Then I have to update and look at my other companies, how they would face this risk. Then I update that. I make new valuations. I review the different scenarios. I make new research decisions. And this cycle just goes on and on and on. And eventually, though all that input and analysis and research decisions have to lead to investment decisions. And so here I might take a company that I already am investing in and say that I want to invest even more, or I might want to own less of it, or there might be a company I've never invested in before that I want to add to the portfolio. And when you take all of those investment decisions together, then that's my portfolio. And if we compare that with the US economy, we can see that in the US, it's not just one industry that's creating all the economic activity. There are many different industries that are each contributing, and there are good investments across many different industries. I have slightly larger holdings than average in tech, metal, sustainability, health, and gaming. And the largest companies in my portfolio now include Aurubis, the German copper recycler, Barrick Gold, Centene, Leidos, Weyerhaeuser, and many others. In total, 60 companies I'm invested in. You can see if you just log on to eToro. It's always available for everybody to see what I've invested in. And then that was my presentation. Now there'll be the opportunity to ask questions. So if you have a question, please just write it in the chat, and then I'll just go through them and answer as many as we have time for. If you have a question later that you didn't get to ask, or you only thought of it later, then you can always comment on any of my posts on eToro, where I'm on eToro every day, including weekends, including holidays. There's never a day where I'm not looking at the markets in one way or the other. You can also write me on LinkedIn or watch some of my content on YouTube. And thank you everybody for listening. And now I'll look at the questions here. So, what is your opinion for the long term on Meta and Tesla? So we'll start with Meta. So I certainly think Mark Zuckerberg is one of the all-time greatest CEOs. I think he is very unfairly criticized for the skills that he lacks and not complimented enough for the skills that he does have. I think I saw that Haugen, as she gave her speech down when we had the big conference in Lisbon, and I think it's an unfair criticism. I'm not completely convinced about these massive drainage of our cash that's now going into the metaverse. I have called the Quest 2, and I think there are many problems with certainly virtual reality as it is right now is not that interesting. It's not something that people really enjoy using. Users use it for a little bit, then they get bored with it. But that could potentially change down the line. And then there are some very good sort of strategic fits for why Meta should be overly invested in this. And I think it's a company that's at many times managed to respond really well to challenges. So something's come along, posed a severe challenge, and they responded really, really well. And I think on some of the challenges they face now, I think they'll do that too. So I think at the very, very low price and the very, very high profits, I think it's something I'm happy to have in the portfolio. Tesla is much more expensive compared to the likely profitability we'll see in the next few years. So they certainly need to engineer more, to break through scientifically on more things. But they have some of the best engineers in the world that are working very hard to solve some of the world's biggest challenges. And maybe they'll solve them, maybe they won't. Maybe oftentimes you have to. There's a famous Danish entrepreneur. He always said whenever he hears a time estimate from an engineer, he always multiplies it by 3. And I think that formula may be okay for Elon Musk as well. So when he says we're going to have this next year, maybe it's going to take 3 years. If he says we're going to have it, maybe more than that. There's certainly some ratio there where the time frames aren't always to be trusted. But I think if you have some of the smartest people in the world working on some of the biggest problems in the world, and you already have some sort of steady business going on, it's a good position to be in. But I wouldn't want to put all my money in it. what do you think about the current stock market situation in China and Alibaba? So I think this is definitely something that should get much more attention from all investors than it does. If you really think, 30 years down the line, when you look who was a really good investor in these next 3 decades, who made the right calls right now, I think the people that have understood or managed to cleverly analyze the relationship between the West and China, they will benefit massively. But a lot of people instead want to talk about Ukraine, Russia right now and other things, but that's sort of taking your eyes off the ball. I think that there's you can make a large investment in Alibaba, but if you've sort of set yourself up with the right hedges for it, because there's certainly they could get in trouble, but if they get in trouble, it could very well be because Amazon's stealing their business in other areas of the world, and they don't manage to conquer the world because of the China's relationship with the world. And so, but if Alibaba's failure just accrues to Amazon, then then as an Amazon shareholder, then you're still okay with that. So it can sort of some of the even if you don't really believe in China long term, even if you think there could be more conflict than the weighted average participant thinks, it can still serve a part in the portfolio where you say you are willing to put this bit at risk because you're not putting everything at risk. You're just putting this bit at risk. And there are other scenarios where you're really happy you did it. What's your thoughts on NFTs? So when I showed those big categories of assets like stocks and properties and bonds, all the big ones, there is a sixth category that I call collectibles and alternatives. That's a very broad asset class that encompasses many, many different things through history, including tulips back in the Netherlands where that went wrong, and rare wine, art, Pokemon cards, Magic the Gathering cards, stamps, whale hunting spears, so many different things. If you add up all of these things, then it's a difficult exercise to do, but it seems that the total return is negative on these. So my dad, he had a lot of stamps, and he kept these stamps and they went up in value for a long time, but then they collapsed to next to nothing. And maybe a Magic the Gathering cards will keep increasing in value and then one day go to nothing. And that can very well happen to NFTs as well. So you have some NFTs and they're popular for a while and you like them, maybe you enjoy them, maybe your generation enjoys them, but then in the long term they go down again. And so if you sort of just invest in all of these different alternatives, your overall average return is likely to be negative. If you pick the right ones, then it could be very good. If you pick the wrong ones, it could be very bad. But I think it's, a lot of very rich people have wine collection and have NFTs, but it's, most people that are very rich are not rich because they have these things. They have these things because they're very rich. And so I think this is, especially with an NFT where you don't even get the copyright. If you get the copyright, it's a different story. Then effectively, you're buying a copyright and it just happens to also be attached to some, technological platform or app or something. If you're getting the copyright, it's a different story because obviously copyrights can be very valuable and they're protected by law. Do you have an opinion about C Limited? Not really any longer. I don't cover it anymore. Do you think there is a high risk for the US to go into a depression or for them to actually default on their debt? So I certainly think that the risk of them defaulting on the debt is very close to zero. There is simply no need. Almost all debt is denominated in US dollars. The US Treasury and the Federal Reserve, while independent, so forth, certainly coordinate in the interest of America. And the Federal Reserve is subservient to the Department of the Treasury to some extent. And it would be ridiculous when you have the option to just print more money to default on your debt. Like one is way more painful than the other. One is it's like you have a smooth solution and you have a really, really brutal, terrible one. You're always going to pick the nice one. So there's very, very little risk of that. Now going into a depression, we have a certain amount of pain we sort of gotta go through. Of course, there could come some positive in from the side or another negative in from the side, maybe another pandemic, maybe another big conflict, maybe some big nasty surprise where someone was lying about the numbers or something. These are generally the culprits through history. And a recession used to be defined as 2 consecutive quarters of negative GDP growth. Now it's defined more loosely, so it's just a longer period of at least a few months with poor economic performance across including, and then there's some things that are commonly included like GDP, like unemployment and so forth. But so it's a more loose one. But we're probably going into this very likely we're going to have a negative economic period for quite a while, and so it could be a shorter, really negative one, or a longer sort of wobbly one. Jeppe, considering such impact on the world right now, war, interest rates, inflation, supply chain problems, do you think your models should suffer any kind of adjustment? If not, isn't this the perfect opportunity to increase exposure in your portfolio? Thank you for the time. So there is this common conception that, you know, when the stock price have fallen, now is a good time to get in. And the historical stock market statistics do back that up in the way that if you've always bought right after market has declined by at least 10%, you would have overall made above average returns. So that's nice. The issue with that is that, of course, I know that, and other people know that. And if people already know that, then it should theoretically already be built into the prices. Now, the markets are not perfectly efficient. They are also not perfectly stupid. They are somewhere in between usually. And so just there isn't this idea that, you know, just because the market's fallen, it's a discount. And so me and the market and many others are saying that the economic outlook is not as great as it could be. Thus, assets should be priced differently. One thing that's important to notice with the US dollar is very strong right now, and very often I would say half of the decline is just because the US dollar is stronger. And very often, whenever you hear something, you know, when some years ago you heard the oil price hits a record, it was actually just because the US dollar had gotten really weak. So when you look at oil measured in US dollars, it's suddenly worth a lot of weak dollars. Now things are worth less stronger dollars. So that's sort of that sort of partly explains the recent decline. If you have a scenario with lower interest rates on bonds, lower potential returns on the stocks, higher inflation hollowing out your currencies, and high prices on commodities, then that's just what it is. But if everything sucks, you have to decide what sucks least. So, you know, if cash sucks really bad and commodities sucks medium and stocks, they only suck a little bit, then you're like, oh, give me stocks. They suck the least. And similarly, if you're in a time where, you know, stocks are amazing, bonds are amazing, currencies are amazing, then it's like, okay, fine, you're still going to want stocks. So it's sort of where they are relative to each other that matters, and not so much whether everything is great or everything's terrible. Someone says, thank you, Jeppe Kirk. Very interesting. Not even the strong earning reports could save stocks like Apple and Microsoft. What are the signals you are looking for the rebound? So I don't look at any signals for the rebound. This idea of that's short-term thinking like, you know, I should hold out until the price becomes a little bit lower, or I should wait until it starts increasing a little bit again. No, I evaluate these companies and I evaluate that they are great companies that are already profitable with great growth rates, great potential futures. There are many scenarios where they could become much bigger and much more profitable. And based on that, I want to own parts of these companies. Now, I'm not waiting. If we, like, it doesn't, there's no waiting. Like, you need to have a portfolio right now. What are you going to have in it? There's no sort of, if I'm like, by the time that these stocks have come down in price to the point where you're hoping they'll rebound, it's a different world by then. Then they might not be worth as much, or they might be worth more. They might be comparing them with other assets. So that sort of that doesn't really help. You have to compare what are these companies worth compared to what they cost, and compare that to what's the alternative, and then based off of that, make one's investments right now. It's no there's no sort of waiting for the rebound. What's your thoughts on Neo? It's I don't. There are lots of new companies in this space that I think are gonna burn through a lot of cash and not really make it back. And I'm afraid this could very well be one of them. Many Danes have shares in Teva because of Core. What do you think about it? I don't have a view on that one. What did you learn from the certification that eToro required? Anything new that you are applying now? Definitely not. I learned nothing from it. And the only thing I learned is that, what did I learn from it? I already did a master's degree in finance, and I worked in consulting, and I already did all the certifications that were required. When I was consulting for one of the world's largest banks in London, they made me do these things all the time. So this, get this certification, get this certification. 1 year later, get the one you did last year, because now you got to redo it. So I already knew all of that. So when I did this, it was just sort of I did it very quickly. I think I was one of the first of the popular investors to complete it because I already knew the content. But I would say I think a lot of the questions in the exams were phrased quite poorly, and I think the book was very I didn't really like it. What are your thoughts on Activision Blizzard and Corsair, please? So I think Activision Blizzard, along with many other gaming companies, has suffered from absolutely terrible management. They are bad for gamers as well as for shareholders. They don't know how to make games. They don't know how to make money, and that's just a curse that this world is suffering through, and that needs to be changed. I think it's an incredibly valuable company. The assets they own are so valuable. And so I'm very sad as an Activision Blizzard shareholder that they will likely get acquired by Microsoft at a way too low price. And then, I'll have to recuperate that on my Microsoft investment. Corsair, I think they've, the core of their industry is one that's quite we call like red ocean. There's lots of companies competing for this, and that means that it really limits what kind of margins you can squeeze out. But that could change in the longer term. I think they are focusing on some of the right things. They've got a good long-term strategy. They are they got a little boost during COVID from some of their products being really demanded for everybody having to be working from home and suddenly needing for instance a pair like this and then if you compare that with the sort of growth and profitability and whatnot, then it's an overall okay deal. I don't think it's the greatest investment of all time, but I think it's an okay one. With Bitcoin now positively correlated with the stock market and gold also failing as a hedge, are there any safe havens left? The thing is with a lot of safe havens, once it becomes commonly known that they are safe havens, they cease to be safe havens because people bid them up in advance. So if people think like, gold is going to be really good if there's a recession, then everybody bids off gold in anticipation of the recession. Then when the recession comes, gold doesn't move because it was already bid up, and that can sort of happen with anything because it's a collective phenomenon of what we believe others believe will be safe, and then we want to have that because then we are safe because we have something that other people want when they want to feel safe. And so it would be very great if Bitcoin could have sustained that for a long time, but it's simply unrealistic. No asset can just continue to be a safe haven again and again and again and again. People learn, people adapt. Considering we are moving to a multipolar world, where do you see Europe standing in 10 years? So there's certainly a lot of things wrong with Europe and a lot of things that need to be improved in Europe. I think it's very sad that we have, not managed to develop a really strong Silicon Valley-like place. And I still think there are some of the companies in Europe that are really nice, and I think these can do really well in a multipolar world or in a if globalization is allowed to continue at full pace, they can do very well. I also think we are helped a little bit along by nearshoring and automation. So when the core cost of operating a factory was where can you get the cheapest labor, then it was nice to go where there was the cheapest labor. But if a factory is very automated and the real big cost is where can you get the smartest engineers, then some of the more well-educated nations come sort of back in force, and we may have a time where just having the largest population isn't the most important. It's more having the smartest population and the best technology, and there we can sort of come a little bit back and shine. And then Europe is sometimes a bit underrated in terms of some of the things that we do well that aren't captured by GDP. So if people are living slightly healthier lives or choosing to spend more time with their family or something like that, or valuing to visit historical buildings or nature, then that might not be captured in those economic numbers I did before, but it's captured in other places. It is certainly something that shouldn't be overlooked when you're making political decisions. What is your thoughts on Tilray, news about legalization in Germany, and CEO's vision to expand into other countries beside the US? So overall, I think it's an amazing company. I think they have a great CEO and a really good strategy. I think that this market can become very big in the very long term, but a lot of the valuation early on was based on this happening in the more medium term, based on quicker US federal legalization. Now, Germany is a good market too, and there are some opportunities that Tilray is in a very unique position to take advantage of. So I think that's very good. But I think it's fair that the stock took a dive when it became clear that we will not get the legalization in the US as quickly as we were all hoping for in this industry. But then, of course, now so you're getting a much worse company, but you're also paying a lot lower price. So that leaves it off as a pretty good investment. Do you think the EV market will triple by 2025? 2025. Don't want to comment on that. Do you have any thoughts on the carbon credits market? Well, I think the prices are quite low, and I think so you have sort of the carbon credits. You also have the offsets, and I think there's been a lot of problems with the way the offsets were implemented. Carbon credits have been implemented in a more nice way, and I think of all of the sort of tools we have to stop global warming, this is the best one because it's the one where you simply use the power of pricing. Many people have never learned about supply and demand and don't really understand how amazing a tool pricing is to set things. When in the 60s, the Soviet economists, they were looking for a tool to get more efficiency in the Soviet economy, and then when they came to America and learned about pricing, they were just like, oh my god, this is like the tool we've been looking for, but for various reasons they could never really implement it to the same extent. But the idea that if we don't want something, then we should make it more expensive, and if it's too expensive, then people are going to use less of it. That should be the case with anything that pollutes. You want to emit methane, you want to emit CO2, you should pay for it. You should pay dearly. You should pay to compensate for the entire value destruction that's done. That's like obvious. If I take $100 from someone, I should give him back $100. You can't just be destroying value and then getting paid to do it. It makes no sense. So this is an extremely important tool. As an investment object, they themselves might not be that interesting. It requires political will to really buy them off of the market and then increase the price for the ones that are left in the market. One of my companies is doing well on the offsets. So that's a warehouser, because they have so much forest. Then whenever they cut down some of the trees and they are turned into houses and furniture and whatnot, then that those new trees planted suck out CO2 from the atmosphere, and then it's stored as products and as houses, and that actually causes them to suck out quite a bit of CO2 from the atmosphere every year, and then they get paid in the offsets in this. And this could potentially be very good business in the long term. I recall last June or July you had to close access to new copiers as you reached the max at eToro. Today you mentioned 60 million. Can you share what happened? So I hit the cap was 75 million, and then now it's at 63 million, and most of that has come from like the 10% market decline, and then I think I went from 25,200 copiers down to 24,900 or something like that. So it's sort of it's both of those effects. It's always going to fluctuate, but effectively once you reach the cap, there is sort of a natural push downwards, because when you can't get any new copiers, then you will slowly be losing copiers, because so there will always be a little bit of copyists that have to leave for whatever reason. Maybe they need the money for something else, or maybe they died, or maybe for whatever reasons they have to. The worst is when some people have their stop loss triggered, and then their position was closed, like, oh, can I copy again? It's like, no, sorry, there's a copy block. But yeah, that's luckily not the case now. It's at 63, so there's opportunity for new copyists to copy, and then once it hits 75, it's probably going to be closed again. What are your thoughts on Indian economy in next 5 years? Yeah, so it's one that I've had difficulties squaring, because I really like it, but I speak with a lot of my Indian friends and they all are very pessimistic. So it's certainly something I need to research further. But I think it's vital for the world that we make it work, and that's the bull case for India, basically, that you have the biggest country in the world. It's a democracy, and India, in terms of when you look at this Russia-US conflict, or Russia-China semi-alliance and whatnot, India has chosen to continue to buy oil from Russia. Sorry. And sort of many in India remember that the US supported Pakistan, so they don't feel any sort of strong national obligation to necessarily support us as much as the other side. But I think in the long term, India believes in democracy. It has a very big population. You're seeing that some of the largest tech companies have Indian CEOs now. So I think if you take all of that together, you just need to iron out the various issues. Then you have potentially the big next growth story for the world. What are your thoughts on UK and European markets in the next 2 to 3 years? So for the UK, they have every opportunity in the world to make insane growth in that country, and they are probably not gonna utilize it, and that's just a big waste. There is so this is really, really sad, but I think it's very likely that the UK is gonna fuck it up and that they won't really live up to the potential there is. And that's just I guess that because of the political landscape. And Europe overall, we are in a tough economic spot. So the next 2 to 3 years economically certainly don't look that well. But there are individual companies that, because they don't need to focus on that, they just need to keep doing what they're doing, and then they will be extremely well rewarded in the long term. And these are the ones you need to pick out and have in the portfolio. 3D printing market is growing very slow at present. What are your thoughts on the future of this market? So I think this is a very overrated technology. I don't think it's very interesting. I think a lot of, there's also sort of a definition question. If you have anything is anything is basically a 3D printer, right? If you just have a machine and it puts some things together, you could sort of say, oh, it's 3D printed it because it's put some things together. Anything is sort of spurs out some material, you can say like, oh, it's sort of 3D printing it. So you're thinking the real big question there is whether or not you're going to have micro factories. Are you going to have a little 3D printer in your house or neighborhood that can create anything you want, like the replicator in Star Trek? Or is it still more efficient to have bigger mega factories that are producing everything and then shipping it? And it's quite likely that the benefit from being able to do it at home is just that you can steal other people's designs, and you can go in breach of copyrights and whatnot, but that production wise is actually cheaper to just have big mega factories producing everything you want, and you just customizing it to your desires. Maybe you want a very particular cool unique thing, so you go in online and you design it and you order it and you have it shipped, but it's still going to be made in a mega factory. So I think it's a very overrated useless technology. Thoughts on exploration and mining in Greenland? Very interesting potential, a lot of minerals for tech production. I haven't looked at that in many years. I looked at that many years ago as in management consulting, but I haven't followed up on it since. So yeah, maybe that would be interesting to go back and have a look at. China stocks good buy now? I think many of them certainly are. I think even you always have with a lot of them to have a level of skepticism about what it says in the financial statements and get sort of verification for some of the numbers. So if they say the number is this, then you say, okay, let me also find some other angles so that I can double check this. But then with that, there are some companies with incredibly good employees delivering some extremely high quality products and services, not just the cheapest, but also in some areas the best. And these are not costing that much. I think, there's certainly some big potential for downsides. They could, if there is more of a conflict with the West and China, they could certainly face big issues. But, after deducting from that discount, then I think you're still left with some very good assets. Okay, one last question it says. Thoughts on cloud and cybersecurity companies. So see what I can say here without sorry, no, I don't want to comment on that. Effectively, I think I have some thoughts that are very different from the markets on these, and that's a competitive advantage. So I think that was it. So yeah, thank you everybody for listening in, and have a great evening. And yeah, see you all next quarter, or maybe before then on